Good afternoon. Sorry about this 10-minute delay. We had some technical difficulties, but we pulled it together. So hopefully everybody is still here with us. Welcome to our latest edition of the Stowe and Deegan webinar series. I'm Marty Croyle, and I'm pleased to be your host for today's event. Next slide. The title of our program is the One Big Beautiful Bill Act and what it means for your 2025 taxes. We all know about the new bill. We also know that it came with a bunch of tax changes. And today I'm pleased to be with my two colleagues, Prasanna Kidambi and Sue Porter, who will be delivering the technical part of this webinar. Next slide, please. 3 housekeeping things. We like your questions. So please, the easiest way to get your questions is to put them in the Q&A box at the bottom of your screen. We'll address them at the end. And if time runs out, we will get back to you in the next week with answers to your questions. Number 2, you can take notes, but you don't need to. The presentation is being recorded. If you would like a copy of the program, just email any of us at Stowe and Deegan. And we also have a new YouTube channel. And our channel name is on the screen right now. And in a few days, this program will be up there and you can see it there. And you can also see any previously recorded webinars we've had. And 3, feedback. We like your feedback. There'll be a brief anonymous survey at the end. You may talk about our technological difficulties today. That's okay. Your feedback helps us improve our future sessions. Next one. It's August 12th, 2025, and we're delivering the best information we know about the One Big Beautiful Bill Act as of today. And we all know that things change in a heartbeat around here, especially in Washington. So please, we're not able in this short period of time to do a deep dive on all the tax issues of the One Big Beautiful Bill, but we're doing a flyover. We're trying to tell you about all the different areas that you should be aware of. So this program does not serve as a personalized consultation for your specific tax circumstances. We strongly urge you, if you have issues, to deal with your personal advisors, and you can always contact us at Stowe and Deegan to help. Next slide. So for the next 35 minutes or so, we're going to talk about the tax impacts on individuals. Prasanna will handle that. He'll turn the microphone over to Sue, and she'll deal with the business aspects of the One Big Beautiful Bill. And when she's done, she'll turn it back to me, and we'll do Q&A. So without further ado, Prasanna, take it away, please.
Thanks, Marty. Good afternoon, everybody. Thank you for joining us today. My name is Prasanna Kidambi. I'm a tax partner here. I'll be walking you through the individual tax changes under the One Big Beautiful Bill Act and what they mean for you and your family. Before we dive in, a quick reminder, just as Marty pointed out, I'll say it again. Today's discussion is just a high-level overview. Everybody's situation is different. The right tax strategy depends on your own unique circumstances. So please don't make any decisions based on what you hear in this session. Talk to us, talk to your advisor first. This law has been named the One Big Beautiful Act, partly because it has so many new provisions. Some of them are extending old rules, and others introduce brand new opportunities. My goal today is to explain what's changed, who it affects, how you can start thinking about planning ahead. We'll be doing more than one webinar on this topic. So if you'd like to know more about something specific that we did not cover today or covered briefly, please do let us know in your feedback, and we'll address it in the next webinar. The first thing is the lower individual tax rates. Before the Tax Cut and Jobs Act, which was passed in late 2017, the highest marginal rate was 39.6%. This law reduced the top rate to 37%, but it was scheduled to expire at the end of 2025. What the Big Beautiful Bill does is make these lower rates permanent. That means the current rates that you've gotten used to since 2018, including the 37% top rate, will stay in place going forward unless Congress changes the law again. For high-income taxpayers, that's a permanent 2.6% drop on the portion of the income tax at the top rate. So for example, if you earn $1 million a year, that's a $25,000 savings each year. So while 2.6 might not sound huge, when you translate it into dollars, especially over many years, it can have a meaningful impact. Child tax credit. Before the Tax Cut and Jobs Act, the child tax credit was really only $1,000 per kid. And the phase out started at a much lower threshold where it started at $110,000 for married filing joint and $75,000 for single filers. Many middle income and upper middle income families saw their credit reduced or eliminated entirely. The TCJA made it more attractive. They increased the credit from $1,000 to $2,000 and also put in a higher phase out thresholds where it was $400,000 for married filing joint and $200,000 for other filers. This allowed many more families to benefit from it. Again, those rules were supposed to expire at the end of 25 as well, but under the Big Beautiful Bill Act, not only do we keep these higher thresholds, but the credit also goes up from $2,000 to $2,200 per child. Though the phase out remains the same, the credit itself will be indexed for inflation, so it should go up a little bit each year. The next change is something brand new, a senior personal exemption. Before 2018, we all had personal exemptions. It was $4,050 per person in 2017. But when the Tax Cut Jobs Act came into effect, personal exemptions were completely eliminated in exchange for a much larger standard deduction. The One Big Beautiful Bill Act brings back a version of this personal exemption, but it only brings it back for seniors. So if you're 65 or older, you now get a $6,000 personal exemption on top of your standard deduction. It does phase out at a lower income level at 75,000 for single and $150,000 for married filing joint. However, for many retirees, this is an extra break on top of the existing higher standard deduction. It could make a noticeable difference for people with fixed incomes. Next slide, please. Next, we'll talk about the itemized deductions for the next couple of slides. The first one is the SALT cap increase. This is obviously a big change which impacts a lot of people in Massachusetts. Before 2018, there was no dollar cap on the amount of state and local taxes you could deduct. So if you paid $25,000 in property taxes and $15,000 in state taxes, you could deduct the entire $40,000. Then came the Tax Cut and Jobs Act in 2018, which imposed a $10,000 cap. And that $10,000 cap covered property taxes, real estate taxes, and state income taxes. This cap hit residents of high income, high tax states, especially like New York, New Jersey, California, Massachusetts, because they often pay more than $10,000 in combined property and state taxes. The One Big Beautiful Bill changes that in a big way. This cap is now $40,000, and the phase out starts when the income reaches $500,000. This benefit is reduced by 30% of the excess income over $500,000. So if you made $600,000 in a year, so your income is higher by $100,000 over this 500, so your deduction would go down by 30%. So you're back to that $10,000 cap. So this is obviously not going to benefit the high income earners, but it should be a significant benefit for upper to middle income tax earners in high tax states. And they would be able to deduct most of their state taxes and real estate taxes again. It also means that the pass-through entity taxes would still be relevant for high-income individuals who often own flow-through businesses like S corps and partnerships. For those who don't know, the pass-through entity tax is a state tax that your partnership or S corp pays at the entity level instead of you paying it personally, so you're not limited by the $10,000 cap. Excuse me. The next one is the mortgage interest. Before the Tax Cut and Jobs Act in 2018, you could deduct interest of up to $1 million on your mortgage debt for your primary and secondary residences, plus an interest of up to $100,000 on your HELOC. The TCJA limited that significantly. It brought the maximum debt eligible for interest deduction to $750,000. It also disallowed the deduction for interest on HELOCs unless the proceeds were used to acquire, construct, or substantially improve a qualified resident, and the total exemption was now limited to $750,000. It's not changing, but it now makes that limit permanent. So if anybody was counting on it going back up, that's not going to happen. So people are still in expensive real estate markets like San Francisco, Boston, New York. You're still going to be limited by the amount of interest that you're going to be able to deduct. The next one is the charitable contribution. There are two pieces to it. The first is the above the line charitable deduction. So if you remember, before 2020, charitable contributions were only deductible if you itemized. If you took the standard deduction, you didn't get any tax break for giving to charity. That changed temporarily during the pandemic, where Congress allowed an above the line deduction for people who took standard deduction. The deduction was much smaller then. It was $300 for single and $600 for joint. Excuse me. The One Big Beautiful Act makes a version of that rule permanent. It now is $1,000 for single filers and $2,000 for joint filers. So, and because it's above the line deduction, you get it whether you itemize or not. It's not huge, but it's meaningful for a taxpayer who doesn't have enough deductions to itemize and can see a little benefit from giving charity every year. Next slide, please. The other piece to the charitable contribution is the thing that's in the itemized deduction. Now, because they're giving you an above the line deduction, there is a 0.5% of AGI haircut in these charitable contribution. What that means is that if you made $500,000 in a year, the first $2,500 of charitable contribution is not deductible anymore. What does that mean from a planning standpoint? This is where the bunching comes in, maybe like grouping 2 years of contributions into 1 year so that you're not taking the haircut every year. And so you get over the standard deduction in 1 year, maximize the benefit, and then take the standard deduction in the off years. So overall, we talked about the big pieces of the itemized deductions, which is the SALT change, the mortgage interest, which is not really a change, but a change towards being a permanent cap of the 750, and the change in charitable contributions. The next change is the overall haircut on the itemized deduction calculation itself. Prior to the Tax Cut and Jobs Act, there was something called a PEAS limitation, where it reduced your itemized deduction by 3% of the amount where if your income exceeded certain thresholds. Now they bring back something similar into picture. It's a 5.4% reduction on the lesser of your itemized deduction or the amount of income above the 37% tax bracket. So it obviously only applies to people who are in the highest tax bracket. So it pretty much applies to the high income earners. So for example, if you made $700,000, or say, actually, if you made $900,000, you're going to be around $200,000 over the highest tax bracket. And if you have $150,000 in itemized deduction, you compare that 150,000 and the 200,000, you take the lower of the two, and you apply that 5.4% haircut to that $150,000, which comes to around $8,000. So now instead of a $150,000 deduction, you have a $142,000 deduction. This is important again for high earners. The value of your itemized deduction kind of goes down because of this. This is another reason to coordinate the timing of the deductions, like the bunching the charitable gifts that I just talked about, to make sure that you're getting the most benefit in the years when you can itemize heavily. Next slide, please. I'll just talk about the next couple of slides at a high level. The first one is the AMT. Prior to the Tax Cut and Jobs Act, a lot of people, even the middle income earners, used to fall within the AMT bracket. And the Tax Cut and Jobs Act kind of did away with that problem by increasing the AMT exemption amount and the phase out thresholds. They have now made that permanent. So it should still continue to keep the middle income filers out of AMT. The miscellaneous itemized deductions, which I think we get this question a lot still of unreimbursed job-related, W-2 related expenses. Those are still not deductible. They were not deductible when the Tax Cut and Jobs Act got passed, and they've kind of kept that rule still going and still suspended. But it's not permanently being done away with, but I believe it's suspended for a few years. Casualty losses are now allowed for both federal and state declared disasters. Previously, it was only for federal disasters. A state declared wildfire or flood that didn't receive a federal deduction could now be eligible for the casualty loss deduction. Documentation is obviously still important with regards to this. Keep declarations, insurance statements, repair estimates, and everything. Educator expenses, they broadened the eligibility for this. It's after 2025, it's going to be more an itemized, miscellaneous itemized deduction. It's not subject to any 2% cap. Right now, we have a $300 cap on this expenses. That cap goes away. So it broadens the definition of eligible educators and expenses. So hopefully more people will get a bigger benefit for it, and would be able to kind of use more of the deductions. Next slide, please. Besides those structural items, there are also these few targeted deductions like the tips, which is $25,000 that one can deduct. Overtime pay for a single, it's $12,500, $25,000 for joint. I'm not 100% sure how these amounts would be made available for like a tax preparer. I'm presuming that the W-2s should have some sort of an additional box which would provide that information so people will know as to what is exempt. Both these tips and overtime deduction does phase out. It phases out at $300,000 for joint and $150,000 for single. The next one is the adoption credit. The adoption credit becomes a partially refundable credit. So historically, if you didn't have enough tax liability and you couldn't use the credit right away, you carried it forward. Now, even families with lower tax bills can now get the immediate benefit. That could be a meaningful change for adoptive parents, as we all know how expensive that process can be. The 529 accounts are broadened, covering more K-12 and post-secondary expenses. Some additional vocational and credentialing expenses can now be covered in order to pay for these expenses through the 529 account. This is obviously a big one. That several energy credits are now supposed to sunset earlier. So if you were considering putting solar panels, heat pumps, geothermals, buying electric vehicles, putting on new windows, you must act before the end of 2025 to be eligible for these federal tax incentives. Next slide, please. Let's change gears a little bit and talk about estate taxes. One of the things that it doesn't impact everyone, but for people it does. It can be a very meaningful number. Right now, under the Tax Cut and Jobs Act, the federal estate and gift tax expense for federal is around $14 million per person, and it's around $28 million for a married couple. To give perspective, before the Tax Cut and Jobs Act in 2017, this exemption was $5.5 million per person. So we've more than really doubled the amount you can pass free of federal and estate and gift taxes. And this was supposed to go down to $7 million at the end of 2025. So the One Beautiful Bill Act has now increased this limit from $7 million to $15 million per person, and $30 million for a couple. Absent this bill, a lot of estate plans, which were between $7 million and $15 million, would have needed a lot of planning and a lot of strategizing to be done before it vanished. Though the urgency is gone, the planning opportunities still remain. Keep in mind that these numbers are just federal exemption numbers. Some states like Massachusetts have their own version of estate tax, and their threshold in Massachusetts is right now $2 million per person. So you can be exempt federally, but still owe a lot of state level taxes. So even with these higher exemptions, smart estate planning still matters. It's still important to think about your gifting strategy. It's still important to think about whether you should move some of your assets into different trusts. Portability elections are still important. Bottom line is, permanent higher exemptions does not eliminate the need for thoughtful estate planning, especially for those states with lower thresholds. If you're close to or over the limit, or if you haven't reviewed your estate plan since 2018, it's definitely worth a fresh look. Next slide, please. Let's shift one more gear here from estate planning into something that can be a real game changer for entrepreneurs, investors, and anyone who works with startup equity: the Qualified Small Business Stock Rules, or the QSBS. The One Big Beautiful Bill Act has made one of the biggest changes we have seen into the QSBS in years. Before we get into the updates, let's quickly recap what the QSBS is. The provision under Section 1202 of the Internal Revenue Code lets you exclude all or part of the gain from selling stock in a C Corp as long as the certain other requirements are met. Obviously, we can have a separate webinar to talk about all the requirements that form part of the QSBS. But one of the things that people needed to keep in mind was the magic number was 5 years. You had to hold the stock for at least 5 years for you to have an 100% exclusion. And the company's gross assets had to be under $50 million when the stock was issued. The exclusion itself was capped at $10 million per taxpayer per company, or 10 times your basis, whichever was greater. With regards to the OBBA, they have now made it more flexible for people to get the benefit of this gain exclusion. So previously, like I said, you had to hold the stock for 5 years in order to get the 100% exclusion. Now you have to, even if you hold the stock only for 3 years, you get a 50% exclusion. If you hold the stock for 4 years, you get the 75% exclusion. So it definitely creates flexibility for investors who want to have more liquidity access earlier without losing all the tax benefits to it. We talked about the $50 million threshold at the time of issuance. This $50 million has now been increased to $75 million. This threshold will also adjust annually for inflation, meaning more higher growth startups can now participate in this QSBS. The maximum gain exclusion, like I said, it jumped from $10 million now to $15 million. And again, this is going to be capped for inflation as well, starting in 2027. So this is definitely a huge benefit, but it only benefits for the benefit only applies for stock that is issued after July 4th of 2025. Anything purchased before that date still follows the old QSBS rules. These changes have definitely expanded the pool of companies that qualify, shorten the holding period, and increase the potential exclusion amount. For founders, this can be meaningful and give more flexibility in raising capital. Now that we've covered the key provisions of the qualified small business stock, I think we need to shift gears a little bit more and talk about businesses. The OBB has significant provisions that could change, impact entity choices, deductions, and how certain transactions are structured. I'm going to now hand it over to my colleague, Sue Porter, who will walk us through what businesses need to know and strategies that they should be considering right now. Thank you.
Thanks, Prasanna. Hi, everyone. Thanks for joining us today. As you probably heard, there's been quite a number of changes regarding businesses. A lot of these changes have taxable income limitations and phase outs. So as you go through the slides, it's important to keep in mind that when you're doing your tax planning, since a lot of these provisions are interrelated, you must consider all the changes rather than just focusing on any one particular area. I'm going to try to focus today on the key, most important business changes. The first change deals with the qualified business income deduction, or QBI deduction. To give you a background on this, the QBI was originally part of the Tax Cuts and Jobs Act. You might remember at that time the corporate rates were reduced to 21%. So Congress wanted to give small businesses that operated as partnerships, S corps, or sole proprietorships a break in order to try to equalize the tax rate. So by giving these type of entities the qualified business income deduction, instead of paying a rate of 37%, it dropped their rate to about 29.6. Still a little bit higher than the corporate rate, but still a good deal for them. In general, the QBI deduction equals 20% of your qualified business income. There's further limitations for specified service trader business, and for both specified service trader business and other types of businesses, there's phase out once your income reaches a certain threshold. So for specified service trader businesses, such as your accountants, your doctors, your lawyers, and your consultants, once you reach that income threshold, the QBI deduction can be totally gone. For those non-specified service trader business, you have to apply additional limitations. based on wages and or a percentage of wages and the unadjusted basis of the property. So without getting into the nitty-gritty of all the mathematical changes, the slide shows the increase in the threshold amounts, which came about as part of the bill. For our married filing joint taxpayer, the threshold increased from 100 to 150,000. So if you're looking at the example, you could see under the old law, the deduction for the qualified business deduction would be 37,840. Under the new law, it'd be 45,227. So this is definitely a benefit to businesses. At a 35% tax rate, it'll save you about $2,600. The other change made by the act is that they made the qualified business income deduction permanent. It was scheduled to phase out at the end of this year. Next slide, please. There's been a lot of changes in the depreciation area. The Section 179 deductions has changed under the act. The effective date of these changes is for assets placed in service after 1/1/2025. Keep in mind when you're doing your planning, there's a lot of different effective dates. So before you go ahead and do anything, it's always helpful to check with your advisors. So the Section 179 deduction allows businesses to expense the cost of qualifying equipment and software immediately in the year it's placed in service, rather than having to depreciate it over several years. The maximum deduction under the act increased to $2.5 million, up from $1,220,000. What this means is you can write off $2.5 million of qualifying assets immediately in 2025, as long as the total cost of your 179 property is below the phase out threshold. And under the new law, the phase out is $4 million. So your 179 deduction will fully phase out once your purchases reach $6.5 million. So if you're not qualifying, if you don't qualify for the 179 deduction, the good news is that you can still take bonus depreciation. Bonus depreciation was made permanent under the act at 100%. Generally, bonus depreciation applies to assets that have a useful life of 20 years or less. Prior to the act, the bonus depreciation was phasing out. It was 40% for assets placed in service after 1/1/2025. Like the 179 depreciation deduction, bonus depreciation allows you to immediately deduct the cost of qualifying assets. Now, the effective date for these assets is property placed in service after 1/19/2025. So if you acquired the property before 1/20/25, or you had a binding contract to acquire the property, the old rules will still apply and you'll be stuck with the 40% on those assets. The research and development expenses, I know that some of you have been waiting patiently for these changes. They're finally here. Under the old rules, starting in 2022, domestic research expenditures had to be capitalized and amortized over 5 years. For foreign research expenses, they had to be capitalized and amortized over 15 years. Just note that there's no change to the treatment of the foreign research and development expenses. The change is only to the domestic research expenses. Next slide, please. The new law allows you to deduct 100% of domestic research and development expenses starting in 2025. There's an exception for small taxpayers, those whose average annual gross receipts are less than 31 million. Excuse me, they can go back and amend their 2022 to 2024 returns. Excuse me, and take the deduction. The downside to amending, however, is that It is currently taking the IRS a long time to process these refunds, so you may have to wait to get your money back. Next slide. There's a lot of planning in the R&D area. You need to evaluate what makes the most sense for your business based on your taxable income. Excuse me, and consider the impact of an increased 179 deductions and other changes. As far as the mechanics for changing the treatment, we'll need to wait for guidance from the IRS to see how to implement the change. You might recall when we first had to capitalize the R&D expenses, we didn't have to file a formal change in accounting method. We just had to attach a statement to the returns. So like bonus depreciation, another depreciation change deals with qualified production property. This is a brand new part of the depreciation rules, which allow for immediate expensing of certain non-residential real property. This is an area where we'll have to wait for the IRS to provide us with more guidance. There's a lot of rules and definitions in this area, as you can see on the slides. So some of you may be asking, can I write off 100% of my building? The short answer is it depends. If it's mixed-use property, part of it can be written off. If it's a full-blown manufacturing facility, and it doesn't have any offices or other types of spaces, there's an opportunity for you to write off 100%. So like any other area of the tax law, there's a lot of caveats we have to look at here. You can see all the rules listed on the slides. I just want to go over the basics. The qualified production property, excuse me, applies to non-residential real property. The property must be used as an integral part of qualified production activities. These activities are defined as manufacturing, production, refining of tangible personal properties. Excuse me for 1 minute. I'm just going to grab a water. So if you think factories, refineries, and manufacturing facilities, these are the types of properties that will qualify. Just an item to note, the Act specifically excludes restaurants. So other rules, the property must be located in the United States. The original use of the property must begin with the taxpayer. Generally, it must be new construction. There's an exception for property that was not used in production for the time period January 1st of 2021 through May 12th of 2025. If you look at the slides, next slide, please. There's key dates when construction must start and end. And also the property must be placed in service before 1/1/2031. So as I mentioned before, some components of the building are specifically excluded from the deduction, such as office space, lodging, parking facilities, sales activities, research activities. So if you're constructing a new facility that has this type of mixed use, you probably want to have a cost segregation study done to help you identify the portion of the property that qualifies as qualified production property. One other thing added by the Act, if you sell or change the use within a 10-year period, then you may have to recapture this deduction as ordinary income. So for example, if you convert the manufacturing facility into an office space, you may have to recapture as ordinary income the previously taken deduction. One of the other areas that's worth mentioning is that if property is used by a lessor, it does not qualify as production. I know that a lot of you have your buildings in a separate LLC, and if you lease your building to the manufacturing facility, it will not qualify. It has to be used by the taxpayer. Some commentators think there may be a technical correction in this area, and we'll just have to wait and see. Next slide, please. Okay. Business interest expense deduction. So basically what the business interest expense deduction is, and this generally applies to larger companies or taxpayers. So under the old law, the deduction for your business interest expense was limited to 30% of your adjusted taxable income plus your business interest income plus any floor plan interest for those of you that are car dealers. Your adjusted taxable income was calculating by taking your earnings and then adding back your interest expense, basically the EBIT calculation. The Act changed the calculation by allowing you once again to add back depreciation and amortization in arriving at your adjusted taxable income. You can see now that the 30% is applied to a much higher base, so this is going to benefit a lot of taxpayers and result in a higher deduction. The other area that you're going to want to look at is if you had carryovers of investment interest expense from the prior year, because of this higher base, you may also be able to use part of that carryover. And just for an effective date, the deduction applies to years beginning after 12/31/2024. Next slide, please. Okay, the next area I want to talk about is qualified opportunity zones. Qualified opportunity zones are investments made in economically distressed communities. The original rules came about as part of the Tax Cuts and Jobs Act. It allowed taxpayers to invest eligible gains in qualifying opportunity zones, and it could be capital gains from the sale of assets like stocks, bonds, real estate, or the sale of your business. And by investing in these qualified opportunity zones, it allowed taxpayers to defer recognition of the gain until the earlier when the property was sold, or 12/31/2026. Investors also received a preferential tax treatment based on how long the property was held for. So if you held the investment for 5 years, you'd get a basis step of 10%, which means you could exclude 10% of the gain. If you held the investment for 7 years, you could exclude 15% of the gain. For investment held 10 years or longer, you would pay no tax on the appreciation in value of the qualifying investment. Now, the chart shows a summary of the old and the new law. Excuse me, the first area is the designation. Under the old law, opportunity zones were set once and expired after a fixed period. Under the new law, there's going to be designation every 10 years and with a redesignation process. Excuse me, also added by the new law was the addition of rural opportunity zones. As far as the gain deferral, the deferred gain was recognized on the earlier of the sale of the investment, or 12/31/2026 under the old law. So any of you that have invested in these opportunity zones, you're going to have a big tax bill coming due in 2027. Under the new law, investments made after 12/31/26, the deferred gain is recognized the earlier of the sale date, or 5 years later. I mentioned the basis step up or the gain that's not taxed. It's 10% under the old law if held 5 years, and you got an additional 5% if you held the property for 7 years. Under the new law, the 10% for 5 years is still retained, and they added a 30% exclusion of the gain for rural investments held 5 years. The permanent 10-year exclusion, if you held the investment for 10 years under the prior law, the appreciation was excluded. Under the new law, it extends, the 10 years is still in place, but it extends to investments held up to 30 years. And with that, I'm going to turn it back over to Marty.
Thank you, Prasanna, and thank you, Sue. Sorry again for the late start due to our technical difficulties, but we pulled it off. As you can see, there are a lot of changes, a lot of tax changes in this new One Big Beautiful Bill. And you can get a copy of this webinar by contacting anybody at Stone Diggin, and then we will send you a link to the webinar as soon as it's available. And also, I mentioned earlier that we have a YouTube channel now, and the address is bit.ly/Stodigon, and the webinar should be, recording should be on our YouTube channel in a few days. Couple of questions we've got. I make a couple of comments. Prasanna talked about tips, and he wasn't quite sure how they're going to be reported. I believe there's going to be a separate box on W-2s for the tips. I'm going to guess this will be kind of a pain for the restaurants and other people who are paying the tips, the companies that pay the tips. One of the nice things about this tax act ending, being signed as early as it was in the year, for those of us who remember the 2017 tax act, that was signed the last week of December. We've got plenty of time this year to do some planning. And as you can see from the conversation in this webinar, there's a lot of numbers, there's a lot of starting dates, there's a lot of ending dates. But we do have time to do our planning. Couple of questions. One is, a lot of the things you guys talked about today were marked as permanent. Does that mean that some of them are temporary?
They haven't made it easy. There are some that are temporary. There are some that are permanent. There are some that starts in 2025, and there are some that starts in 2026. We can put together a little table and chart instead of talking about it, and maybe share it with the people in this webinar in terms of different start dates and what is permanent versus what's temporary.
Great, thank you. You mentioned that the green energy programs are ending early at the end of the year, at the end of 2025. If somebody is planning to do something, can they purchase it by that date? Or do they have to have it installed? Does it have to be working? What are the rules on that to get a credit in 25?
The ideal thing for somebody is that they should be put into use. So that is the ideal metric to be at in terms of being eligible to take, for commercial buildings, to be able to take depreciation on things, as well as from a credit perspective.
So it has to be installed and working.
Yeah.
So people who are wanting to do something in 25 better get at it quickly.
Yeah.
Okay. Question about the qualified small business stock. You mentioned it's a C Corp. Does that mean it can't, I cannot do it for an LLC or an S Corp? And the second question is, when is the right time to plan this QSBS?
Yeah, so that's a good question. It only applies for C Corps, and it only applies, in general, I feel like we talk about QSBS a lot, but it doesn't always apply. But I think with these provisions being so much more favorable, I would think that in the next few years, we're going to see a lot more of these. Having said that, it only applies to a C Corp, so it doesn't apply for S Corps or partnerships. And what is the right time to plan for it? I would say as soon as possible. In fact, you should be thinking about what is the right entity type for you right when you incorporate, whether it's in some cases an S corp or a partnership works, but or in a lot of cases S corps and partnerships works. But there might be some cases where a C corp might be a better option, especially for high growth companies where the owner is not putting in their own money into the entity.
Okay. There's one more question. There was a mention or two about a technical correction that we might be expecting. Sue and Prasanna, do you anticipate there'll be some changes before the end of the year?
So it was related to, yeah, sorry. Go ahead.
Yeah, I think so. I think what we're going to see is the IRS issuing frequently asked questions in this area, especially on the new provision with the qualified production property. The definitions, if you're not manufacturing, they kind of limit the production to chemicals, and people are going to try to squeeze into those areas. So I think we're going to have to wait for the IRS to provide guidance on that. Whether or not it's going to come out this year remains to be seen. I'm sure we're also going to be waiting for rules on, how to implement the R&D changes.
I would agree with you, Sue. I think we should expect some corrections and some updates. And the Q&A, the frequently asked questions is a good comment too. So we are talking internally about doing another tax webinar before the end of the year. That's something that we are talking about now. As we mentioned earlier, we're going to ask you all to complete a short survey. And if you would like to hear more about the tax changes or any specific parts of the tax changes, if you could write that in on your questionnaires, and we'll address that in a future webinar. So we're at the witching hour. I don't see any other questions. So I want to thank Prasanna and Sue for doing a great job. This is obviously a huge amount of tax changes, and with lots of different dates, percentages, start times, end times. So please contact your advisors or us if you need help. And thank you for joining us today, and enjoy the rest of your day.